Very good afternoon and welcome to HYCM's online trading workshop with myself, Giles Copeland, the Chief Currency Analyst here at HYCM. Now, I hope everybody is doing well. I'm just going to be taking us through where we are with a dominant currency sentiment, so I can help you guys recognize how to take advantage of recent sentiment moves. We're also going to quickly run through the market, give us a bit of an overview where we are here as we approach midweek. I hope everybody is doing well. Nice to see you all. Nice that you could make it for the session. And I'll identify an opportunity that's potentially setting up on the ASX 200 and just outline what I'm looking at. It's a trade that I'm personally in, and I'm just going to run through that with you as well during the session. As folks are coming into the webinar, don't forget that as we go through different entries, exits, the whole idea of this webinar is not a signal trading service. The whole idea is that it's an educational service. So you look over my shoulder and you see someone from a professional trading background, how I go about making decisions, and that helps you inform your trading decisions and how you trade. So that's the way that it works. I hope that is clear. I have to say that because sometimes people get confused. I think if you mention an instrument or an entry that it's true for all time. Obviously, market conditions change constantly, so you have to use your discretion and you have to use understanding and knowledge which comes in time. Okay, with that being said, we're going to crack on to the webinar. Now, the key principle that I teach every single week on the Wednesdays is the same principle that I use every single day. Whenever I'm looking to trade, I'm looking to back strength against weakness. In exactly the same way, you can see this strong arm, and you would favor the strong arm to, more often than not, beat the comparatively weaker arm on the right-hand side. So strength should overcome weakness, and that's what we're looking for. Each day, we're trying to pair a strong currency up against a weak currency. So that's a key kind of trading principle. And that's what we're be looking at for the session. Now, in the session ahead, we're going to be looking at the current market, going to be going through some of the major pairs, just running through them, explaining what's going on with them, as well as the special topic we'll be looking at support and resistance and how you can use that for entries and exits in your trade. So that's the rough outlook. So without further ado, we'll head on over to the charts. There we go. Now, let's just do a quick tour of markets. So first of all, looking at the equity markets, what we see is we see that equity markets have been broadly moving higher over November. You can see that here's the futures markets. You can see that the major indices had very, very good Novembers. And if we just made this into the monthly chart, you'd see that very strong gains seen in all the major currency pairs, not currency pairs, all the major future indexes. Now, those gains have been for two reasons. One, a Biden presidency. It's seen as positive for growth. Joe Biden is going to be positive for US fiscal stimulus. He's also going to be positive for pulling back from some of the US protectionist policies that President Trump used. So the market expectations have been met, and we're seeing equity markets rise on the announcement of a Biden victory in the US elections earlier in the month. And we also have the Pfizer, BioNTech, AstraZeneca vaccine news. So equity markets have had this double dose of optimism. And that's why we're seeing equity markets move higher. And those equity markets, I know European equity markets had about $1.7 billion going into them. So there's a huge amount of flows going into equity markets at the moment. And if you notice, airline stocks are rising, cruise stocks are rising, the banks are rising, expecting dividends to start paying again. So market investors are positioning themselves for a year of growth in 2021. So that's the first thing to be aware of. The major indexes are buys on dips. Now, that doesn't mean they're just going to keep going up and up and up. But obviously markets have retracements, they have pullbacks, but essentially the main markets are opportunities to buy on the dips. Now, there is one index that is worth bringing your attention to, and this is the Australia index. Now, you see here, we have this trend line break to the upside, okay? We also now have a bit of support coming in at the top of this trend line here. Now, there is a bit of support coming in around this area here. So this could be a potential area to go long with stops just nice and tight below that 6440 region. So if you just look at the trend line, you can see that this trend line was resistance, and resistance turns support. So you can use these trend lines for entries and exits. So I'll show you a trade which I took on platinum. I did flag this up on my blog back in 24th of November. I did give the outline. Make sure you have links to my blog. I'll just put this to you in the question and answer session. I'll just put this here. I'll just put it in the chat. I'll just give you the link to my blog. I just outlined the fundamental reasons that I was expecting platinum buyers. You also see platinum tends to be very strong at the year end. You tend to see a little bit of growth, and there is demand was greater than platinum supply for this year and for next year. So I was expecting platinum to keep moving to the upside and just very, very simply use a trend line break. And you can see all the way back here from 24th of November, just took a nice break to the upside on that vaccine, on that platinum demand issue. So you can see there, trend line break to the upside. Now you might have taken this and seen price move back up inside, so you could have moved the trend line up higher and taken the break from this level. Either would be legitimate options for buying platinum. And then we see platinum just breaking through those highs from August 2020. So that's a simple way. Entries, trend line break. Also, these major support resistance levels tend to be excellent areas to take profit. So just not particularly looking at this chart suggesting that you would have been selling in August, you probably would have been buying. But if you saw market, if you were selling and you saw market dropping, you'd want to take profit as you hit these major support and resistance levels. These major support and resistance levels are very often respected by the market, and so when you move into them, you want to be taking profit. So here, for instance, as you move back into this area, you saw key profit taking. So those support and resistance levels are key areas of profit taking. Similarly here, being long, you don't want to hold into this level here. You can see here, this is a key area to take profit because you would expect some pullbacks as you head into that profit taking area. So use the major support and resistance levels for profit taking and entries. Don't try to break through every level because you won't. Even in bullish markets, levels, they hold at these overhead resistance levels. So you certainly want to bank some profit as you head into those levels. Don't keep waiting for new highs. They don't always come, even in a very bullish or bearish market. So make sure you take profit at those levels. So that's an opportunity that is, arising here in the major indices. If this, another way in is if this bar closes within this bar today, then a break to the upside would be a good possible opportunity for moving higher in the ASX 200. Remember, that's a futures contract. If you're trading it in the futures market, make sure you check the rollover date so you don't get caught out on the rollover of the futures contract. And if you don't have access to that market, just ask your account manager and they will give you access to the ASX 200. That's Australia's major benchmarks. So you can see here, we have equity markets moving higher. Now, alongside equity markets moving higher, looking at bond yields. This is interesting. We saw some sellers in bonds yesterday. Now, when bonds get sold, the yields rise. So what this means is that bond traders are starting to liquidate some of their long bond positions. Now that means they want to put the money elsewhere. So it's not going to be surprising if we start seeing bond traders taking money out of bonds and putting them into equity markets. So the higher these yields rise, that will also support the futures and the major indices higher as well. So this is the 10-year bond yields. You can access these bond yield charts on TradingView. All you do, I'll pop it in the chat. You go to TradingView, and like here's one bond yield that you often see spoken about, the US 10-year bond. You just use that code. Okay, I'll put the code and use this code, US 10-year. Okay, it's in the chat. And you put that in TradingView, and then you'll get this bond yield. And generally speaking, with a risk-on market, you see bond yields moving higher alongside equity markets moving higher. So that's what you're looking for. So long story short, yields are moving up higher today. So that's positive for sentiment. We're also seeing commodities moving higher today as well. Like we just take a look at commodity markets, oil, it's been pushing higher since the positive vaccine news. Brent crude pushing higher. We also have obviously Bitcoin been moving higher. That's been on a massive move, hit an all-time high earlier in the week. We've had silver and gold moving higher as well. Although remember, if the bond yields start moving higher, that does pressurize gold. So bear that in mind. Copper futures also ripping massively higher over the last few days on optimism, global growth. So it wouldn't be surprised to see a little bit of pullback. So that's where we are at the market, and that's the risk with this ASX 200 trade, is that we see a bit of a pullback back deeper down. But this is the key area of, if this is going to hold the support, that's what will hold. So that's what we're looking at there in terms of the ASX 200. In terms of the currency strength and weakness, let's just have a look. I'm just trying to move this. Just have a look here. You can use this website for free, and you can, for free, get your own currency strength meter here. So you can see today that we've got some strength in the US dollar, and that US dollar strength is this bit of pullback we're seeing here, dollar index bottom right. Okay. We're also seeing a bit of strength in the euro, mixed bag though, some weakness euro CAD, euro Swiss franc. We're also seeing weakness in the pound. We'll cover that in a minute, why that's happening. Strength in the Swiss franc, weakness in the yen, and we're seeing broad strength in the commodity currencies, the Aussie CAD, but a bit of weakness in New Zealand dollar. So the risk tone is tilting towards the upside, but it's quite mixed at the moment. If we just look at the S&P 500 futures chart, and if we just look at futures markets on a 30-minute chart, you can see that we've been trading sideways. Okay. In terms of data that we have coming up, we do have some ADP employment data coming up in the afternoon. So if that ADP employment data is better than the market is expecting, then that will be really helpful for market sentiment. We'll just have a little look at that to show you what the market's expecting. Market is expecting a reading of 410,000. Anything above 550,000 for the ADP employment data will likely boost risk sentiment higher. This employment data flows through into the non-farm payroll data on Friday. So anything that's strong here will be supportive for sentiment. Now, if there's a weak number, anything weaker than 195,000, that will end up equity markets falling, but they'll probably be bought. And you probably see a drop lower in futures markets on any bad news, but then a spike higher because traders will be expecting the Fed to ease more and the more fiscal stimulus from the US government. So bad news could be good news later on this afternoon, but it's definitely one area to watch. Particularly now we're seeing a little bit of a doubt, a little bit of weakness in the futures markets. See the VIX, the volatility, the fear index moving a little bit higher. So risk is kind of a little bit neutral, switching to the off side of things. Now, looking at the major currency pairs for today, let's just go through what we're seeing. The dollar has important seasonal reasons for weakness. I'm just going to show you a very interesting analysis of the dollar. Just give me a second so I can pull this together. And let's see, where is the dollar? I'm just going to see this. I did have this up earlier. Bear with me one moment. Oh, I've got it on my blog, so we'll look at that. So do go and check out this article here where I outlined the dollar weakness. And you can see here, when you look at this chart shows the seasonal weakness in the dollar. So over the last 50 years, the dollar loses value in December, okay? Now, there's important reasons why that happens. Essentially, what happens is that companies move money out of their US companies, and they're moving to daughter companies to save taxes. So you see that in December, large US companies, they move the dollars away from their mother companies to daughter companies, and then they come back into the US in January. And it's all about making being as efficient as you can tax-wise. Now, that weakness is a pattern. So the 1st December, 31st December, you can see that the last 50 years, you've had twice as many losses as you've had gains of the US dollar, and the average loss is minus 0.92%, and the average over the returns, but the average loss year on year is minus 2.22%. So in a losing year, the average loss is minus 2.22. So dollar weakness is the order of the day. So that's why, seeing this breakdown of this dollar index, you can see the weakness just coming into the market there as the dollar gets sold off. And that's pretty much what we're expecting. Now here is a little bit of support around that 91. So it's not surprised to see a little bit of a bounce, and even a bounce back up to this 92.30 region wouldn't be, unexpected. So this, the dollar, we're seeing a little bit of recovery in the dollar today, a little bit of dollar strength. That's been dragging down Aussie, New Zealand, US dollar. Now, we would favor still upside bias. When any retracement back down to this level would favor longs in the Aussie US dollar. My favorite area from Aussie US dollar long will be down here, 0.7250, but it may not be one to chase. Similarly with the New Zealand US dollar, could see a long from this pivot point here would have been okay. Also a long from this support resistance here will be potentially okay, because the global growth outlook generally remains stock just running below 0.700. So that's the outlook for the New Zealand US dollar. Looking at the pound US dollar, we saw some heavy selling in the pound off early this morning. That was on news that Michel Barnier said that important differences still remain between the EU and the UK. If you remember last night, the pound rallied hard higher, and that was on news that the EU and the UK could be entering the so-called tunnel. Now, Michel Barnier really got rid of those expectations on the tunnel this morning. So, Michel Barnier was kind of indicating that tunnel is maybe not the case at all, and important differences remain. Hence, we saw this sort of heavy selling in the pound this morning. So that's something to be carefully looking out for as we approach the final deadlines for the EU and the UK. There's no time beyond the end of December, and volatility has been really rising in the options markets. So options traders are beginning to try to price, insure themselves against the Brexit no deal. If you look at the pound, See, the pound's been being bought since the summer on expectations of a Brexit deal. We're now heading into this key overhead resistance level, so it's not surprising to see a little bit of downside action. But what we need to be aware of here is headlines. So I wouldn't recommend trading this until we get some clarity, or you've got access to a professional news squawk. If you haven't got access to either of those, just stay away from the pound for now, because it's too tricky to trade without professional tools to help you in that. And even when you've got the professional tools, it's difficult because the headlines can be fast and furious, contradictory, and interpreted differently. So it's definitely a tricky market to be involved in. So be aware of that. But that's the reason for the pound falling. The pound falling is accelerating on the dollar strength. Remember, when the dollar rises, the major currency pairs drop. So what we're seeing here is a little bit downside in equity markets, a little bit of strength in the dollar, and that's pulling these markets down. Now, the fundamental bias hasn't changed, so I still favor New Zealand US dollar upside, and I would favor buyers from this 0.7028 level. Okay, so any retracement back down to that level can be considered suitable for buying. Not a bad level to buy from. I quite like that outlook. Remember the principle, strength against weakness. We expect New Zealand dollar strength on pro-cyclical growth expectations. The RBNZ has walked back from negative interest rates. There, we've seen New Zealand 10-year bond yields move higher. When these bond yields move higher, it means that bond traders are expecting high interest rates to come. We're also seeing general US dollar weakness. The New Zealand US dollar pair should be strong over the next few days. So I do like a New Zealand US dollar buy from around these kinds of areas. Looking at the daily chart, we can just see that prices moving back into this key area here, and any sort of retest of that area will be suitable for buying. In terms of stops, the ideal place to have your stop will be around this 0.6995 region. It's just stops nice and out the way around this area, looking for a move back higher into this 0.7070 region. So around 50 points, just under 40 points would be what you'd look for in terms of New Zealand US dollar longs. US dollar CAD downside bias remains. Seeing some strength in the dollar yen, the dollar Swiss franc. I'd steer clear of these two pairs for now. One thing to look out for the euro is a couple of things. One, we have ECB's Lane speaking later on. Now, ECB Lane will be speaking, and he could talk the euro lower. There was a time not too long ago when the euro was at 1.20, we had ECB Lane talk the euro lower. So just watch out. Remember, the dollar weakness results in euro US dollar strength. If you haven't understood that relationship, you need to. So just understand that the dollar index is sometimes called the anti-euro index. So if you notice, whenever the dollar index, which is in the blue line, whenever the dollar index drops, the euro rises. So dropping dollar index, rising euro. Dropping dollar index, rising euro. Dropping dollar index, rising euro. They are virtually perfectly negatively correlated. You look here, rising euro, falling dollar index. Falling euro US dollar, rising dollar index. So this push higher in the euro is being driven by a falling dollar index. So if the dollar index starts having reasons for strength, watch out for euro US dollar shorts. Also watch out very carefully for any chatting it lower from ECB's Lane. He's done it before. He could do it again. He's speaking at an ECB board fireside chat at Thomson Reuters Global Investment Summit. So watch out for that going into the afternoon session. So that's a key thing to be looking at. A couple of things to say about next week before I get on to questions. If you've got any questions, please do ask them now in the question panel. So if you've got any trades you want me to go through, anything that you're looking at, please do mention that to me now. Next week, a couple of announcements. On Monday, unfortunately, there's been an error with timings. So the Monday look ahead webinar, I won't be able to do because I am away doing a webinar for a university. And so unfortunately, the timing, it goes across my normal look ahead webinar on Monday. So apologies for that mistake in scheduling. And because the university have already advertised the timings, I can't change it now. So I'm very sorry for that. However, just to whet your appetite, on Wednesday, I will be going through some technical trading patterns that have some be very positive and powerful on the higher time frames. So I'll show you some of those technical patterns, which are really good for delineating and identifying your risk. Okay, I'm just going to go to the question and answer section now. Okay, Anthony, what's the reason for positive news like UK government approval for COVID vaccine not resulting in upward movement for the euro? Right, okay, because this is an important point. The positive vaccine news was being priced in from around November the 9th. So November the 9th is when we had that initial news. You can see the S&P 500 but rammed higher. You can see it more, see it clearly in the Euro stocks. November the 9th. We saw European equity markets particularly benefiting, ripping higher. So Anthony, that's been priced in. Now, the news about the UK government approval, yes, it's good news, but number one, it doesn't trump Brexit news. Brexit news is the most important news at the moment for the pound. Okay, and just going, this could be a good area to buy the pound now because this is key support, and as long as the EU and the UK are talking, you expect the deal to be done. So I'd expect some profit taking here, and it wouldn't be surprised to see some buyers in that level. Now, that's the main news for the pound, with the UK government approval for COVID vaccine. The COVID vaccine is being expected to come, so it's just a question of time. So it's not new, Anthony, in that it's kind of expected, and it's not massively significant because the market's been pricing in that positive vaccine news for a while. And also, UK government approval is not necessarily good news for Europe because obviously they are different areas. And although the UK is still part of the EU, the UK is an island. So with the restricted travel, UK being an island, it just means it's more separated from the mainland Europe. And as I said, in a way, because of that physical separation, it's probably always had a little bit more of a separate identity than some of the land-based European countries. That's maybe just been my opinion, but that's a sort of sense that I get. So there's some of the reasons why that news hasn't had more impact. But basically, that kind of news is being expected now, Anthony. Anthony, I hope that helps. Warren, yeah, 57.8% is the weight of the euro and the dollar index. Yeah, so what Warren is saying here is that the dollar index has a disproportionate weighting towards the euro, which is why the dollar index is so influenced by the movements in the euro. It's also why movements in the dollar index influences movements in the euro. So, if you are trading the euro, US dollar, and if you're trading any major currency pair, you always want to have the dollar open, because when you look at the path of the dollar, you can see how the other currency pairs will move. So you can see here, look, as the dollar is selling off from that pivot point, look, you can see that there's support coming in these pairs: New Zealand pound, Aussie US dollar. Okay, you can see some support coming in with that dollar weakness. Oh, hi, yeah. So yeah, S&P 500. Now, let's have a look. S&P 500. Now, I did have some analysis on the S&P 500. Just see if I can. Just going to see if I can find the. Oh, so don't forget this on the Trading Insights. If you want to see a little look out for gold buyers heading into end of December, do check out that video. That's a really good video there. See if I can find. Right, yeah, here we go. Right, so this is the S&P 500. So Yasser, do check out this video here. And in this video, I'm just going to play it for us because it's helpful to see. Welcome to HYCM Insight with myself, Giles Cochran, the Chief Currency Analyst here at HYCM. The seasonal insight for the session ahead is as follows. The so-called Santa rally is a very strong time of year for the S&P 500. In fact, over the last 70 years, the S&P 500 has gained between December the 15th and January the 1st for a total of 54 out of those 70 years. The average return has been plus 1.61%, and the total annualized return will be 37.75%. The largest gain was a whopping plus 8.53%. So will vaccine optimism this year help investors? Will buyers step in and push the S&P 500 up higher trade risks? Now, the main risk to this trade outlook is if there is heavy equity selling or risk-off trading on any rising COVID-19 lockdowns or any other fiscal stimulus or Fed intervention concern. Right, so you see there, Yasser, that out of the last 70 years, 54 of those last 70 years, the S&P 500 gained. So this time of year, seasonally, is often very strong. Now, one of the reasons for that, my suspicion is that as bond yield coupons get paid, some of those bond yield coupons get put into equity markets. Equity markets tend to rise most between November and April. You've heard, Yasser, the saying, sell in May, go away. Well, that is a true phenomena that you can see across the world indices. Over the summer months, from like May through to September, you tend to see the equity markets being flat or falling. But from November to April, equity markets tend to rise. So you can see here, you get quite a lot of money coming in, and in the new year, particularly in like German DAX, see a lot of inflows in the new year, like stocks like Adidas tend to do very well at the start of the year. So look out for this. So S&P 500, the pressures to the upside, Yasser. So what that means, we just go and have a look at the S&P 500. So like yesterday, yeah, making fresh all-time highs, right? Now, what we have here, right, that's interesting. We've got like a bullish Harami inside pattern. So I would favor upside from here. And from a weekly perspective, say buying around 3645, stops 3543, and playing to the upside. I think that looks potentially quite attractive. On a smaller time scale, any retracements, basically any retracements back down here could be considered opportunities for buying. Okay, so here would be ideal. That would be the perfect area. I don't think we'll necessarily get there. Here, so that 3635, 3588, Now, what would change that outlook, Yasser? What would change that outlook is if we saw, you know, if we saw any, how can I put it, rise in COVID-19 cases, US fiscal stimulus not coming, you know, anything that's very negative. But with the Federal Reserve coming, they're going to be doing some kind of fiscal, some kind of quantitative easing acceleration. So all of that supports equity markets. So for me, they're very bullish, Yasser. Even though they're at all-time highs, that is quite a bullish technical setup here. So the way in would be a market-ish 3645, stops running at 3542, then just running the thing higher, trailing stops behind each weekly high. So each time, the way to do it, I would potentially enter here and then bring your stops behind each weekly high and just trail the stop up like that. That would be quite a decent little move, and potentially you can see quite a lot of upside on that. And then if you don't, well, your risk is limited to that 3542 region. Yeah, so that's how I'd look at that. Yeah, good. Yeah, so I'm glad that helps. So you can see the fundamentals, the seasonals, everything is looking good for the S&P 500, and you could run that into the end of December, and your risk is there. So that's one to keep a careful eye on. Okay, folks, I hope that's helpful. Thank you for the questions. It keeps me on my toes. And I hope that's all helpful for everyone, given a few ideas as well. So everyone have a very good week. We'll be back here on Wednesday, but please note, I'm not here on Monday. So please don't waste your time and accidentally come along, but I am due back here on Wednesday week. Look forward to seeing you. And I'll also give you my holiday dates as well, because I'll be away at the end of December until the start of January. Thanks, everybody. Do take care. Have a very good afternoon, and thank you very much for your time. Yeah, thanks, Warren. It's been great. I really enjoy this session I have with HYCM clients. It's really good to have you, and been getting to know some of you over the years. So it's really great to see you still at it and still tugging away. And yeah, you know, come back here and let's try and build something good. Okay, everyone. Take care, everyone. Thanks now. Goodbye.